Hey everybody, I'm Dave Briggs. Markets around the world are plummeting, and the question is coming fast and furious here at the New York Stock Exchange and elsewhere. Is the Fed too late? Let's talk about it with Jacob Sonnenschein, stock pick writer at Barron's. Jacob, thanks for being with us. It is a lot of red on the numbers. Now, we have recovered a bit from session lows, but still between the Dow, the S&P, and the NASDAQ still down between 2 and 2.5%. You break it, you buy it. Did Jerome Powell break it?
Jerome Powell may have broken it by doing the 11 or 12 rate cuts that we've seen since early 2022. The economy is decelerating. This is what the Fed wanted. This is really healthy. The stock market had an incredible, like kind of a historically good, solid run for a long time, and it got really expensive. And the economy needed to slow down because inflation was way too high, and the level of prices are still high. So maybe Powell broke things over the last 2 years, and now the rubber is hitting the road. And I think that the market technically may have some momentum going down. There's just a lot of selling pressure. You know, I could see a scenario, wake up tomorrow, we're down 1%, not 3%. But we might have some momentum on the downside. But at some point, when we can get into this, you might want to buy the market.
For the layperson first that sees what happened Friday, then they hear about a 1987-like crash in Japan and then see the numbers this morning. Back us up and just give us a little context, what got us here, how significant the jobs number was on Friday into leading to this point.
The 87 crash, people were concerned that something was a little bit broken. Look, that's always on the table. That's always a possibility. I don't want to be naive. I don't think right now anything is necessarily broken. What the issue is, when you looked at trading action on Friday, this whole sell-off started on Friday. I mean, it started a little while ago, but it was pretty bad on Friday. And you know, the jobs report was much weaker than expected. It was the worst jobs report in a period of years. And the deceleration in jobs added happened really quickly, I think to the tune of tens of thousands of jobs from the prior result to the July result. You do have restaurants, even McDonald's, even others, sit-down restaurants, talking about traffic being down year over year as inflation, high prices, high rates are starting to make people say, hey, I gotta walk it back on spending. Manufacturing is down month over month as well. There are a lot of areas of the economy that are getting hit. But I think, you know, I don't think anything is broken. I think the market is realizing, because the data that we've gotten in the last few weeks, we're now moving from like 2 to 3% real GDP growth to just decelerating from there. So it's a bit of a worry.
With the caveat, Jacob, that no one speaks for Jerome Powell, how do you think the Fed chair reads what's going on right now?
Look, you know, I read a comment from an equity strategist today saying that Jerome Powell, when he made the interest rate decision, when he talked about maybe rate cuts last week, he may have known that the employment data was going to be weak. He may have actually gotten word about that. I think here's the point. A week ago, I was saying I don't know that the Fed should be cutting rates until we get down to 2%, because if that's the goal and you're at roughly 2.5%, why would you cut rates and recreate, you know, the problem of inflation, move it back to 3.5, whatever you have? Why would you do that? I think here's the point. The Fed will try its best to walk the balance of keeping inflation down in the 2 area, but also avoid recession. But if you're an equity investor, here's what I think actually matters. At some point, you want to start dollar cost averaging your capital into the equity market, because the Fed has made one thing very clear. If it needs to cut rates, it will. And the rate of inflation and the rate of real economic growth has come down in tandem over the months here. And so if things get bad enough, the Fed has already made clear whether a September cut is, you know, appropriate or not, it will cut if it needs to. It has the ability to.
Then there's the issue, Jacob, of an emergency cut. And one of the more respected minds in our field is Wharton professor Jonathan Siegel, who says this is time for an emergency cut now, and at least a 75 basis point cut in September. What's your reaction to that?
No, I think that's a bad idea. I think that's a hot take. I don't know why he's saying that. I would love to talk to him. I don't know. He also probably is more of a macro economist than I am. I am certainly not that. I study the equity market, and to some degree, you have to study the economy. That guy may have a better read on it than I do. But again, look, if the Fed's goalpost is 2%, and they have the luxury to cut soon, we're almost there. They're making clear that they'll cut if they have to, if they think they basically can. But cutting by almost a full point, when you're not even at your 2% target, come on, I don't really think that makes any sense. And I don't think being in panic mode is ever a good idea unless you're in like the financial crisis.
This is, however, the first time we've heard the R word tossed about in a couple of years. Do you see any sign of a potential recession?
Yeah, I see signs, and we've had like a little rolling recession here and there in between sectors. Home improvement was really bad for a while. Rates were higher. People were not investing in their homes as much as they had been. Not nearly. Manufacturing recently got a really bad reading, a contractionary reading. Restaurants are down in terms of traffic year over year, so prices are up, but real activity is down year over year. And so we're seeing it roll through a little bit, but I think you could have a mild recession that is not here today, that could be here in the next few months, next few quarters. You have a mild recession. The Fed will be there. Inflation will get down to 2% if they let it. But if you're an equity investor, I think you should know that rates have peaked already. A recession would be mild unless something is broken. But if not, you go in and buy soon. I don't know about, this minute. And a mild recession isn't the worst thing in the world.
So you see some opportunity here. Is it in particular sectors? Is it in small caps? Where is it?
Yeah, I think once things have stabilized from an economic growth standpoint, it is small caps, it is cyclical sectors, nothing too cyclical because like airlines or copper miners or oil producers, they tend to be so high volatility because of their cost structures and leverage on the upside and the downside with revenue, that they're just good trades. But you want to look for good investments, but in small cap land where things are super cheap, in businesses that do have some cyclicality, maybe restaurants, maybe home improvement. There are some long-term growth drivers in housing, like millennials and my peers coming into the housing market, and technology and artificial intelligence. As things get cheaper, you want to look for those opportunities.
Yeah, you mentioned housing, mortgage rates certainly going to be maybe not plummeting, but certainly coming down from highs. Is there an opportunity as far as investors go with mortgage rates coming down?
Yeah, one of my favorite plays in home improvement, two of them are Sherwin-Williams and Lowe's. Sherwin-Williams is executing really well, so that you can expect them to either post the growth that you're going to see in broader home improvement or take share, because Kelly Moore Paint is going out of business. I believe they have filed for bankruptcy. Sherwin has been taking share and executing really well. And they sometimes deserve a high valuation, a high PE multiple above 20 times. But if you can get some earnings growth, stock buybacks, reduce the share count, EPS growth around 10%, they're a good play. Lowe's is similar, but Lowe's is expanding it into the higher margin pro business, higher priced, higher margin, slightly away from do-it-yourself, more middle income. And so Lowe's has some growth drivers, and they historically execute extremely well.
Great stuff. The Mag 7 also selling off. Looks like around $1 trillion of value shed. Is there any names among the Magnificent Seven that you say this is an opportunity?
NVIDIA, AMD, Broadcom, Meta Platforms. These are great companies. And like I said earlier in this segment, the selling momentum may have to be bad it may have to continue for a few days, a few weeks, and that would be healthy. And there is risk to earnings to anything that has sensitivity to the economy, including internet advertising, including the production of chips for various devices and even the data center and stuff like that. But these are great businesses that have the assets in place to sell the right things at the right time, that are in demand, that are growing, and at some price, those companies are worth an investment.
All right, good stuff. Let's circle back to where we started here and wrap up on Jerome Powell and the Fed. You've ruled out an emergency cut. What do you see happening in September and for the rest of this year?
Well, from my 7 years of covering markets, every time I see a 100% chance that the Fed is going to do X or Y. I'm thinking back to 2019, thinking to now, whether it's a cut or a hike. When you see a 100% chance in the market that the Fed's going to do something, usually you never get to Fed day and like they just have this surprise. They're going to cut in September. I don't know if that's the best decision. It is defensible. There is a lagged impact of still higher rates that is we're seeing starting to roll through the economy. So they'll do it. They'll do a cut. I don't think the 75 basis point thing makes any sense. I'm not an economist. Maybe I'm missing something, but the cut that we're expecting in September, I think is what we're going to get.
All right, great to get your perspective. Jacob Sonnenschein, stock pick writer at Barron's. Really appreciate you jumping on. Cheddar, last second here. Thanks, buddy.
Thank you.